At a Senate Finance Committee hearing on October 1st, Congress convened to discuss taxation of digital assets and the path forward for legislation. Industry leaders, including a representative from Coinbase, were on hand to testify. Here are the top moments from the hearing.
Professor Nellen, you teach tax law. If a business receives over $10,000 in cash under current law, they have to submit additional reporting to the IRS and to FinCEN, in large part so the government can spot money laundering and criminal tax evasion. I think you were talking about that earlier with Senator Hassan, right?
Right.
Okay. So one proposal the crypto lobbyists have been floating would exempt crypto transactions from that requirement. Would that proposal make it more or less difficult for law enforcement to counter crypto money laundering and tax evasion?
Well, given the purpose of that provision, and it is already part of the law, it was added back in November 2021, but waiting for regs to make that effective, that is the purpose of it, to help identify where there is just a particular use of that. Some differences, though, between cash and crypto is, on a cash transaction, the customer is most likely right in front of you. That would not be the case. But
I understand that crypto has put out its reasons why it wants an exception. All I'm trying to get at each time is the crypto lobbyists are crawling all over Capitol Hill. And what are they looking for? They're looking for special rules for crypto, and not special rules that sometimes make it more expensive to operate crypto and sometimes make it less expensive, not special rules that sometimes makes it easier to track crypto transactions and sometimes makes it more difficult to track crypto transactions. It's that every one of these special rules tilts in the same direction, and that is for anyone investing in crypto to pay less than the equivalents elsewhere in the financial system.
Cryptocurrency raises important questions for our tax system. Cryptocurrency activities don't always fit neatly into existing law. This creates real uncertainty for taxpayers who are trying to follow the rules and for the IRS as it works to investigate criminal activity. So, Ms. Nellen, given the technical complexity of cryptocurrency and other digital assets, how can Congress and the IRS establish tax rules that both provide clarity to the U.S. industry and bolster the ability of law enforcement to go after criminals who use cryptocurrency for illicit activities?
Thank you for the question, Senator. There's two parts to that. So far as the compliance aspect, the IRS has provided a lot of guidance back in 2014 just by saying under the tax slots property, because then we have a whole set of rules on property.
Right.
Though there are some unique things that happen with digital assets, a hard fork, an airdrop, staking, mining, that aren't really neatly fitting into existing guides there. I think the recent guidance that came along with the broker reporting, where they clarified how we treat amount realized, how we treat basis, that's added clarity, and everybody can follow that and be consistent. So I think so far as calculating gains and losses on most transactions, the rules are fairly clear. When we get into other issues where you're trying to figure out, for example, a mark-to-market rule where it applies to securities and commodities, there's some people think, oh, all these things are securities, they fall under there. Well, that's not true, and it makes quite a burden to figure out if they do fall under there. You also run into inconsistency on that. Another one, I think, where it would be very helpful, there are people that donate, or companies donating the very valuable Bitcoin. I mean, Bitcoin's gone up tremendously in value, and people think, I'll donate it, but they need to get a qualified appraisal if it's worth more than $5,000, and that's puzzling, and some people overlook that. And then, which means that they didn't actually get the donation deduction because they didn't follow the rules, which is really unfortunate.
Right.
To change the rule, make it very clear from Congress doing that, that just like publicly traded securities are a readily valued asset, I think if we could put in crypto that is listed on an exchange, that would really aid in the donation of those items without getting a qualified appraisal, or even knowing if it truly is a qualified appraisal. There's a lot of rules on what makes something a qualified appraisal.
The IRS's revenue ruling 2023-14 has highlighted some of these challenges. Many worry that the ruling is premature, difficult to administer, and inconsistent with longstanding tax principles. Taxpayers want to comply, but they need rules that are clear, practical, and fair. The President's Digital Asset Working Group report published in July has suggested that staking rewards should be taxed based on when there's a realization event, that is, when those assets are sold or exchanged, not at the moment they're created. Mr. Samansato, if the current revenue ruling 2023-14 is inconsistent with these principles, should the IRS consider rescinding it and replacing it with guidance that defers taxation until disposition, just like with other types of property, until Congress weighs in?
Yes, we've called for that at Coin Center for several years since the guidance has been issued.
Thank you. Mr. Zlatkin, how does leaving revenue ruling 2023-14 in place affect the U.S.'s ability to attract innovation and capital in this space?
Thank you, Senator. So this is one of those examples where I think Ms. Warren is incorrect. I think that minors, people who self-create property, this ruling actually addressed this issue about whether tax should occur upon receipt or whether it should occur, as with other forms of inventory and self-created property, whether it should be when you dispose of it and monetize in the form of cash. There's an argument to be made, certainly, I think, and people have tried to make this argument, and have been unable to do so. The IRS has disagreed that should be upon when you monetize the investment. You should be taxed when you monetize it, not when you create the property. So I think rescinding it is extremely important. It will attract more mining activity into the United States. We discourage that by taxing parties only when they receive the mining rewards themselves or when they stake through validators within the United States.
Nashville in Tennessee is really a very friendly crypto state and a friendly crypto city. There's a Bitcoin park that is in Nashville. And what we have seen is that many of our small businesses now will accept a cryptocurrency as payment. The problem we're running into is, should that cup of coffee be a taxable event? And the de minimis issue. So I'd like for you to speak for just a moment. My time has expired now, but speak for a moment about de minimis.
No, I can be real brief. I think it's an important area to bring, as you mentioned, the individual users who want to engage with this technology into a situation where it's not super complex. One of the topics that's come up is the fact that you would still need to track, your spending in order to figure out if you're able to get that de minimis exemption. But I think as you talk about like paying $5 for a cup of coffee or paying a fraction of a cent for a transaction fee, those aren't something that would need to, a deep analysis of whether you fall under the $200 exemption. And so I think that exemption really does lead to the benefit of these individual users in the network.
We haven't gotten into the question of the tax gap associated with this topic. And according to the IRS, the tax gap is nearly $700 billion per year, and that these provisions don't even include taxes on digital assets because the IRS doesn't have visibility into that sector. And I think you all were here when I mentioned Chuck Reddick's comments on the tax gap already. And if the digital asset rules are unclear, it seems to me taxpayers are going to resolve ambiguities in their favor if there is confusion about this. So let's just go down the row, and I would be interested in your assessment of whether I'm correct that that's what taxpayers would do, and would clarifying the rules raise revenue, and try to get each of you, our experts on this subject, get your thoughts on revenue, because I think this is a big part of the debate, and Chuck Reddick certainly lit things up earlier, and now we've got to get down to the nuts and bolts of where we go from here. Why don't we just start on the left and go down to the right?
Yeah, so thank you, Senator. I definitely think that clarifying these areas that we've talked about today is going to lead to a revenue raise, right? This is an incredibly complex topic, as we've talked about, and in a lot of cases, again, you're talking about individual users of these networks that need the guidance to be able to figure out what their tax liability is. Otherwise, they're kind of guessing at this. So.
Major amounts of revenue?
That I don't have a good sense. I'd have to...
Okay. I'm waiting for somebody who's going to define the numbers, too. Ms. Kramer.
Well, starting with the estimate and the numbers, I have no clue as to what the gap might be, but nobody has a clue, primarily because the data is not available. and we don't really have a tracking of the cryptocurrency numbers the way that we do have tracking of all the other financial markets. So that's something that we could benefit from if there was more official tracking. As to, and now I forgot the last part.
No, I think I wanted to get your sense of whether it sounded right in terms of taxpayers resolving ambiguities
yes,
in their
okay.
favor. And
Sure.
then, if you agree with that, what it would mean to clarify the rules. And if any of you want to make additional news today, you can lay out some potential numbers.
Obviously, if you don't have a rule that you have to follow, then you're going to interpret it in your favor. That's just the way it's done.
Thank you, Senator. I totally endorse what you said, that gamesmanship is encouraged by inadequate rules and by lack of clarification, and that's why we're here today. I think we need legal changes to help clarify that. That's an important building block for a compliant tax system. At Coinbase, we pride ourselves really on encouraging our taxpayers to comply with the laws. We have an entire module and help center to try and encourage people to do that. We've endorsed the broker reporting rules. We're building an entire framework with that will report transactions. I would just encourage, though, that each member in the Senate consider administrability in the course of doing that, because this is one asset class that is so democratized that we are talking about billions of transactions. And so what I would encourage the Senate to consider is administrability for over-reporting, for low-value reporting, and even what we call the de minimis transaction. So if you require taxpayers to report 1/4 cent of gain or loss, I just don't know that they're really chasing where the revenue really is. You should be chasing bigger transactions. Again, if you're requiring that stablecoins, all stablecoin transactions will be reported, you're going to be deluged with billions of zero-value reporting, which to me doesn't encourage the administrability of the system, encourage fairness, and it really doesn't create a system that actually works. It will creak under disrepair. The IRS is unprepared. I think the IRS is probably unprepared today to endure or to absorb the amount of information that Coinbase alone will be providing. We're going to be testing that in a little while. So again, let's create a fair system. Let's create rules for the road. We've outlined 10 points where we think we can encourage this industry to grow within the United States. So let's do that. Let's prevent brinkmanship and gamesmanship. But when we create that system, let's also create an administrable system that works.
Ms. Nellen.
Yeah, no idea what the tax gap figure could be, but certainly there's legitimate activity, and just like with cash, there's other things that people might be doing intentionally. Certainly, I think clear rules and anything that can be done to help get more information out, whether from the IRS to explain how all these transactions work, where they have tax obligations. They've got a lot of information out, but a lot of it's not like unique to crypto. It might just be, well, go see this publication on property in general, which might not always help answer the question. So because any resources that can help in getting more tax education out there would be good. And again, as noted earlier, I think actually just getting a legislation passed will draw attention to, oh, I need to understand better my tax considerations here. But I think good reminders to folks that if you had sale or exchange transactions, whether or not it shows up on a 1099 DA, you still have reporting obligations. I think we can learn from existing areas where people are not aware. For example, a lot of people don't know that it's income even if you don't get a 1099 or a W-2, and that just grows with more kinds of transactions that don't get reported. And there are going to be a lot of transactions that don't fall into the current reporting for centralized exchanges. So people are really going to need to know, you need to keep your records, understand tax consequences, and get those reported. Then so far as people engaged in, if there's going to be bad actors, they're going to be bad actors probably with cash or with digital assets, and just ways to have enforcement funded to help address some of that.
For more congressional news, stay tuned to Congress Clips, and thanks for watching.